All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 12 of the Macro Corner podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmuller. The Macro Corner chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to podcast@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. My guest today is Giannis Mindall. Welcome to the show, Giannis.
Hey, Paul. Thanks so much for having me back on the podcast. We got a ton to cover today comparing FOMC projections versus the underpinnings of the U.S. economy. I think there'll be a ton in there for our listeners. So, yeah, let's get into it.
All right. Let's start off with a quote here, though. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. Giannis, can you guess who said that?
That was John Templeton. Yeah.
Oh, you're good. You're good. Absolutely. So let's dive right into it. So the topic, again, as you said, the structural underpinnings of the U.S. economy compared to FOMC projections. So I think what you're getting at here is, are we actually experiencing what the FOMC thinks they're working on, or am I wrong, or how does this work?
Yeah, exactly. When we look at the Fed's two mandates being maximum employment as a proxy for economic stability, economic growth, and then, of course, the 2% average inflation target, we need to ask ourselves whether these targets are realistic or whether the underpinnings, whether the actual economy is ways away from reaching that target in the fullness of time. So what I tried to do with this article that went out yesterday is looking at things like capacity utilization. We'll get into all these technical terms, looking at investment in the real economy, investment especially in old economy sectors being energy, chemicals, construction, and whether from an inflation perspective, the 2% average inflation goal is a realistic goal to have, or whether that's more or less wishful thinking at this current conjunction.
All right. Well, we do see here that in Q1 2022, we had a 6.6 growth and 7.8% in Q2 2022. Now, that doesn't sound too bad to me, but the magic number is that inflation number. So what does that do to those numbers?
Yeah, so you have, on the one hand, nominal GDP, so nominal output. You combine the prices in the aggregate of the U.S. economy, and then in order to get to real GDP, you adjust for inflation, or otherwise you could just print money, create a ton of inflation, and therefore achieve economic growth, which is, of course, not possible. So ultimately, when we get to those real GDP numbers, we saw two consecutive contractions, one in Q1 of this year and then another one in Q2. Whether they ultimately declare this a recession is yet to be determined, but this is what used to be the technical definition of a recession, what we've experienced. And when we sort of look at what inflation means and how it gets produced, it's ultimately a mismatch between demand and supply. If there's too much demand for goods and the economy, the production factors in the economy cannot serve that demand, then you ultimately have prices adjust upward. And the prime example of inflation and the mismatch between supply and demand is the current energy crisis in Europe, where you have inelastic demand for energy and you have supply that doesn't respond to these energy demands, which ultimately creates inflation. So this is a basic economics equation that you would hear in any economics class that plays out when it comes to inflation and the factors of production not being sufficient to serve existing demand.
So going back to that, you know, the energy crisis, as you called it, a lot of it is coming from Germany. We see that the euro today is under the US dollar. You see that, and that I think that this has a lot to do with it. So actually, you have the ability, do we have the ability to increase production when it comes to energy? And how long does it take when a company as large as Exxon in that field plans out their future capital expenditures? What goes on there?
Yeah, so this is not a one size fits all sort of framework that we can apply here. You, of course, had in the US the main contributor to an increase in energy production over the last decade or so, basically since 2012, was shale production, meaning fracking, which ultimately made the US energy independent. Shale production tends to be a bit more responsive in terms of the pace at which you can increase production. So it's ultimately a technology question. It's a question of whether oil services are available. That's also a field where there are constraints right now. So you listen to companies like Halliburton, you listen to companies like Schlumberger, all these companies are basically booked, but shale tends to be a bit more responsive to an increase in price. But then you have long lead time projects such as overseas drilling platforms, which take a long time from the point where you ultimately discover the oil reservoir to the point where oil actually flows and gets distributed to the consumer. So we turn to the IEF. This is ultimately an organization that assesses the state of the overall oil and gas industry. And what their projection or their assessment of the current state in upstream is in 2021, the industry invested $341 billion in CapEx, meaning that's companies like Exxon, like Chevron, investing in oil drilling activities, in developing different oil fields. And they project that it will take $525 billion a year by 2030 to ultimately serve the demand in the economy. Or otherwise, if that doesn't happen, then prices will need to go north in order to create demand destruction or even more incentives for these companies to drill. All of that depends on policy certainty, which is non-existent right now. And that's ultimately getting reflected in the investment plans that all of these oil companies make.
I like what you said there. Policy certainty. If they know what's going to happen, whether good or bad, they can plan out their year a little bit better. And going back to what you were talking about, fracking. So fracking is the process of putting pressured water underground to frack apart the rocks, and then the oil or natural gas can come up through those cracks in the shale. And the United States led that revolution. I do know that there's projects all over the world, though Papua New Guinea being one of them, where you're able to get access to oil and gas that maybe wasn't available before the fracking revolution. So what is, I see here in our chart book, we're talking about open interest. Now, open interest is something that only exists in futures markets. And what does open interest tell us about those markets?
So open interest ultimately tells us how big or small participation is in these markets. I mean, these are ultimately the holdings of participants in the futures industry. And when open interest is really low, that means that for some reason people are not participating in energies, and also to an extent in metals. That is related to what Goldman in the past has called a volatility trap, meaning that prices fly around to the extent that people don't want to participate. Because if you see crude oil move $10 in a day, and $1 equating to $1,000, that's a large move. And even on an industrial scale, on the scale of, say, large energy traders such as Glencore, Trafigura, you name it, they don't want to step in front of a fast-moving train that's gonna maybe get them off sides in certain cases. So ultimately, you see that volatility begets volatility, and that volatility is ultimately a result of the underinvestment that we have seen. Because underinvestment ultimately creates a mismatch between supply and demand, as we've talked about.
Mm-hmm.
And when there's a mismatch, that's when the market ultimately has a harder time in assessing what the fair price of a market is, and that takes volatility to ultimately get to an equilibrium. And one would argue we are not at that place right now. So
Right.
ultimately, open interest being a reflection of the underinvestment that begets volatility, and that volatility begets more volatility, and it might take a different sort of price to settle that open interest at a different level again.
All right. And that, yeah, I mean, another thing to add there as well is, you do have ETF participation. I think there are a variety of ways now for investors to participate in, say, crude oil, natural gas, or copper. That might be a reason why you see lower open interest here with regards to, say natural gas. I mean, today natural gas hit a 14-year high, but look at the open interest. You're only about 100,000 contracts here, and the height of open interest I saw in 2018 was about 170,000. But as I said, there are many avenues now to participate in these markets.
Yeah, just to chime in at that point, when you have open interest go down, that means liquidity in the market is less,
Yeah.
and that ultimately allows for bigger moves.
Yep,
I mean, when you look at the basic dynamics again of what a market is, the less people are willing to step against the motion of a market, the more price will ultimately move. So this is ultimately a really interconnected sort of dynamic we're observing here.
So going back to what we were talking about with real GDP and nominal GDP, what is the U.S. output gap?
Yes. So when we look at the U.S. output gap, what we ultimately try to look at is if the resources of an economy, being capital and labor, are put to good use, are we at full exhaustion of these resources or not? And comparing real to potential GDP, we ultimately want to get an assessment of, okay, how much slack is there in the economy? How much more potential production can be had out of an economy?
Mm-hmm.
And right now we see that real GDP is below real potential GDP, but then it's not just as linear as that number may seem, because there are different sectors in the economy, and different sectors ultimately have different output gaps. You think of sectors like energy, where we're basically at exhaustion because refining capacity is already hitting limits. We'll have refinery maintenance going on in the fall. You turn to sectors like chemicals, you turn to sectors like autos and auto parts. Those are all sectors that are extremely tight already. So that U.S. output gap in the aggregate, that is a result of sectors in which demand is not even there. Whereas you have probably real GDP above potential already, so meaning that we are already exhausting factors of production to an extent where there's no more capacity left. You have these sectors and capital not flowing back into those, such as energy. So comparing the real to potential GDP is ultimately a way of assessing, okay, how much more can we produce given how much resources we have. And while in the aggregate picture of the U.S. economy, we do see that there is technically some room left, there are sectors that are constraining all of this. And this goes back to conversations we had on this podcast before, where we said until capital flows back into old economy sectors, we will ultimately face problems on an ongoing basis.
Yeah, energy being like you said, energy affects everything. Oil is in plastic, oil is in a lot of cosmetics, oil is everywhere. And as you said, that underinvestment really hurting us. Let's flip it around to some bonds here. So you have the 2-year Treasury yield absolutely screaming this year. And what does that actually tell us going forward?
Yeah, so ultimately, when you compare the Fed funds rate, so the policy rate that the Fed sets, and you compare that to the 2-year Treasury yield, those basically walk in lockstep. And one would argue that the 2 year U.S. Treasury note is ultimately setting policy for the Fed, because the Fed, just as everybody else does, listen to the market, and if the 2-year yield keeps being elevated, then that sends a signal to the Fed that a tighter policy framework is required. What we saw happen on the back of the July 27th policy meeting and the ultimate rate hike decision they published, and then the press conference that followed, the market got a pretty dovish sense of it all. And financial conditions being how much credit is there available in the economy, what does the US dollar do, things like that, that ultimately determine the financial health of an economy, and therefore credit creation. Those financial conditions eased by a great extent. They eased to the extent that one might think this is an actual Fed pivot. So there is disagreement out there as it pertains to whether it was an actual pivot. We've been leaning more on the side of it's not been a pivot, it's just been a shift to data dependence, meaning they'll listen to the incoming data and will adjust policy accordingly. But the market got a really diverse sense of this policy meeting, but the 2-year yield ultimately disagrees with that easiness that the market has interpreted the last press conference with.
So what you're saying is that markets are expecting transitory inflation, and we can see that. That's on slide 9 of the chart book here. But also, you're going to have Jerome Powell, the Fed chair, speaking at Jackson Hole. That is the annual conference out in Wyoming. So that's going to be something to look forward to. And I think that will give us a bit of a clearer picture on what's going to happen in September at the next Fed meeting.
Yeah, you put this in really good context here, where you have markets still, despite the high and elevated inflation we've seen, markets are still leaning in the transitory camp. And while the Fed has officially retired the term transitory not too long ago, markets are still having that in the back of their minds, and they're looking back on recent history rather than a period like the 70s where there was sustained inflation. Markets are taking a bet against that, and this goes back to a topic again we've covered many times on this podcast. It's market expectations that drive pricing of risk assets, and the divergence from these expectations ultimately causes a repricing of financial assets. So when you think of, as a market participant, what the market is currently thinking, you have the transitory narrative still priced into risk assets, but then any deviation from those expectations will cause a rethinking, a repricing. So we'll get Jackson Hole on Friday with the opening speech of Jay Powell. These are prepared remarks. This is not like some reporters just asking questions that Jay Powell might be prepared for, but maybe on some not so much. This will be really intentional in many ways, and we'll get a really good sense of, has this been more of a pivot-esque sort of statement that they made last time, or is it just really a move towards data dependence, meaning they'll stay aggressive as long as inflation is high?
Let's cover one last thing before we end the show. Let's talk about the European crisis in general. Like I believe the Germany baseload power, that's in megawatt hours, it looks like it's not at an all-time high. And if you look, it looks like a Mount Everest over here on this chart.
Yes. So ultimately, what we've seen going on with the European energy crisis is that Europe's become extremely dependent on Russian energy, and the money that's been flowing to Russia as a result of increased prices has been extremely elevated. And so what we're seeing with Europe's energy crisis and the energy industry as a whole is that a lack of investment and a high degree of dependency on Russia in this case has led to German baseload power and the entire European energy grid as a whole being extremely constrained. When we look specifically at German baseload power, then we see, as of Friday's close, it was at 550 euros a megawatt hour. That is equivalent to 300-ish euros barrels of oil equivalent. So right now that the euro is trading as a stable coin of the dollar, being at parity,
which means one, just means even. Yep.
Exactly. So right now that's basically more than $300 a barrel of oil equivalent terminal electricity. That is 1 year forward, and as of today, that's increased to over $700, and that equates to over $400 a barrel of oil equivalent. So we see that ultimately it will require massive investment into old economy sectors in order to reduce the burden on the consumer and reduce some of these secular inflation forces that are currently present. I mean, like we talked about in the beginning of this podcast, we have capacity being extremely exhausted in some sectors, while not so much in others. But maybe those other sectors are not as relevant going forward, and therefore it will require fixed capital, fixed asset investment to resolve some of these secular issues.
Right. And I think there might be a social aspect to this story with Germany as well. I do believe that after Fukushima, that was the nuclear power plant meltdown in Japan that got hit with the tsunami. I believe that the German citizens, I believe that the German citizens went to the leader at the time. I think it might have been Merkel, and said, "Hey, we don't want nuclear power anymore." And when you do something like that, and they switched over to Russian natural gas, and you're relying on other people, maybe the leader at the time should have stepped up and said, "Well, no, if we do that, this might have consequences, and here's those consequences," right?
Yeah, and this speaks to this entire dynamic of energy security and the increasing trend of countries turning inward rather than looking at a globalization type framework. They want to secure energy supplies because it ultimately social stability ultimately rests on energy security.
Absolutely.
And when you have a lack of energy, then that can lead to social unrest. We have seen that in frontier markets. We have seen that in emerging markets. We, of course, don't wish for any of that, but we need to entertain the possibility of it. And we just need to be realistic about the future path of what the shape of the economy is right now, and how long it's going to take to build up production capacity in much needed areas.
I agree. Well, hey, thank you very much. That was Giannis Mindahl. Thank you for coming on the show, Giannis.
Thanks so much, Paul. I look forward to coming back on next week.
Absolutely. That was the Macro Corner episode 12 podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmuller. Don't forget, the Macro Corner chart book is available in the description of the podcast, BlueLineFutures.com, as well as attached to the email sent out to clients every Sunday. And if you're not a client, reach out to podcast@BlueLineFutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. Thank you very much, everybody. I will see you next week.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.